Hi, Naveen. Thanks for joining me.
Hey, Susie. It's good to be here.
Well, many of our clients are concerned about the impact of taxes on their investments. How much of an impact might taxes have for an investor?
It turns out it can be pretty impactful. So here's a study from a company called Morningstar looking at how stocks and bonds have done before and after taxes over the long run. Over on the left, you can see before taxes, the typical investor may have experienced gains just north of 10%. But after taxes, that falls to closer to 8%. So that 2% gap, that's about a 20% difference before and after tax on the investor's performance just from tax costs. On the right side of this visual, you'll notice bonds, similar story, but unfortunately, they're even less tax efficient. So before taxes, typical investor likely experienced north of 5% in returns over the long term with bonds, but after taxes, that slips to below 3%. That's an over 40% gap in what has happened before and after tax. So these costs can add up to quite a bit over the long run for investors.
Well, those are some eye-opening numbers. And one common question we get is why might stocks be more tax efficient than bonds?
So a lot of that comes down to the tax code. The tax code looks at ordinary income, and that's taxed at the typical income tax rate, both state and federal, for your typical investor. For bonds, the interest that they pay out is considered ordinary income, so it falls into that category. For stocks, as long as the investor holds the stock for a year or longer, it's considered a long-term gain, and it turns out those tax rates are much lower. So that's a big part of their tax efficiency relative to bonds. But another part of the story is that stocks typically have been more volatile than bonds historically. And because of that, investors have been able to use strategies like tax loss harvesting to further reduce their tax bills in their stock portfolios, which has helped their tax efficiency over time as well.
So the tax code can significantly impact tax efficiency. And there are strategies that investors may consider to potentially enhance their tax efficiency. So Naveen, what are some tax-smart strategies that can help investors keep more of what they earned?
Thankfully, there's a number of strategies they may be able to employ. Some of the ones that our investment team uses help their account initially to get set up for long-term success. So here, it's thinking about transitioning their account to a more tax-efficient situation. Doing that in a thoughtful way without taking on a lot of gains can help quite a bit. Also, selecting tax-efficient investments like stock index funds or municipal bonds can also be helpful. And then finally, thinking about asset location. Where does one keep their more tax-efficient investments or less tax-efficient investments? That can also help over time for the after-tax result for the investor. After those setup situations, we also have other strategies that can help over the long term, but these are more maintenance strategies. So this is thinking about short-term and long-term gains when we manage the account day to day by being thoughtful around things like withdrawals, rebalances, or distributions that can further help with tax efficiency. And then again, tax loss harvesting is a strategy that can help with tax efficiency as well by using market volatility for opportunities to harvest losses for investors.
Let's talk more about tax loss harvesting. While investment losses can sting, the good news is that an investment that has lost money can potentially help with taxes. Please explain how this works.
So let's use an example to bring this to life. Let's look at an investor named Jordan. And in their account, they sold an investment at a $6,000 loss. They realized a loss of $6,000. There's a few things they can do with that. One, they can look at gains in that same tax year and offset some of those. So let's say that same tax year, Jordan had a $1,000 gain in a different part of their portfolio. They can offset that with some of the loss, and then they don't have to pay taxes on that gain. That still leaves $5,000 in losses for Jordan. So with the next $3,000, Jordan can use that to offset ordinary income in their day-to-day life. And that can be an additional benefit of tax loss harvesting beyond just investments. And that still leaves $2,000 of losses. With that last piece, Jordan can carry that forward into future tax years and use that to offset gains at any point in their investment career.
So you mentioned that which accounts you hold your assets in can make a difference to your taxes. That may not be something clients think much about. So can you explain why account type can matter?
So this goes back to the question we asked earlier about different types of tax efficiency for investments. And because many of us have more than one type of account, asset location can help. As an example, most retirement accounts are considered tax deferred. You don't have to pay taxes year in, year out as that account grows before you get to retirement. That might be a good place for less tax efficient investments, like the bonds we talked about earlier. A bond fund or a set of bonds might be a good opportunity for a tax-deferred account. On the other hand, something like a brokerage account that is subject to taxes year after year, and there we might want to locate our more tax-efficient investments. So whether that's stock index funds, individual stock holdings, or even municipal bonds, which are tax exempt for federal taxes and potentially state and local taxes, those are more attractive for taxable accounts. And over time, that small savings from tax asset location can be helpful for investors.
Naveen, thank you so much for all this important information.
You're welcome, Susie.
These strategies can be complex. If you want help with tax-smart investing, reach out to your Fidelity representative. If you don't have one, visit fidelity.com/findinadvisor. And for more timely news and thinking from Fidelity's top thought leaders, subscribe to Insights from Fidelity Wealth Management. I'm Susie Allen. Join me again soon.